China has the world's largest money supply. They've got $47 trillion, which is bigger than both the US and Europe combined. And right now, they're printing aggressively to get out of a crisis that started back in 2021. But that money is completely shut off from Bitcoin. And today, we're going to be looking at why that is and what it's doing to both gold and Bitcoin. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Hey guys, I'm Alessandro, and I research crypto and macroeconomics, distill it down into little chunks so that you can leave better informed and wiser. So today, we're looking at this China gold buying spree and why this money can't flow into Bitcoin. I'm calling it the liquidity wall, right? Why gold is absorbing the money Bitcoin cannot. And the key thing to understand here is that the US and China both go through what are known as liquidity cycles. The red line is China, and you can see China have been consistently flat. Now this is the rate of change, or the percentage growth year over year of China's money supply that is in the hands of people, so not sitting in the central bank. It's called the M2 money supply. Every economy has an M2 money supply. You can see the US is here is in blue and China's here in red. And what you can see is that China's has been consistently growing at roughly 8% per year since 2018. What this has meant is that now China has the world's largest monetary supply at about $47 trillion. For reference, the US is about $22 trillion. And so China's is bigger and it's growing faster than the US is. And this week, actually, global liquidity has just reached a fresh all-time high of about $188.8 trillion. Now this takes into account central banks and M2s all over the world. But the key thing to understand here is that this expansion is mainly coming from the East. It's mainly coming from China. When we measure global liquidity, it's always measured in dollars. And that means that if the price of the dollar goes down relative to other currencies, the pool of capital in global liquidity actually looks like it's increased, even if there's no extra money coming in. So it's not a perfect variable, but know this, decreasing dollar value actually increases global liquidity. We know the People's Bank of China are also increasing the money supply, but you can see here, right, via the People's Bank of China and US dollar weakness, we're getting an expansion in liquidity. And the Bank of Japan, the ECB, and the Bank of England are all contracting liquidity. And why is this relevant, right? It's relevant because if we look at this chart here, this is the Bank of China's liquidity versus gold. And from 2013, you can very clearly see basically the gold price has been tracking close to 1-to-1 the increases in liquidity from China. So it's almost like China are trading the yuan for gold. And the reason that's important is because China, as I said, are going through a very destructive period in their property market right now, and they're trying to salvage it. And so last year, China reduced rates to the lowest ever at 1.4%. They also changed some regulations with banks, which allowed them to unlock even more liquidity, about $140 billion. And the reason why China have been printing, or why they've got to print, is because China are basically in the same spot Japan were in 15 years ago. What happened in Japan in 1998 is they had a property crash, right? And this led to what's known as the lost decade, where there was deflation in Japan, there was debt spirals, and it was a really big issue for the Japanese economy. So what they did is they basically tried to inflate away the debt. It was called Abenomics, and they printed aggressively. So they pushed money into circulation, they reduced rates right down. And what that ended up meaning was the Bank of Japan ended up owning 50% of all the debt in Japan. This was the start of the Japan carry trade, where people would borrow money in Japan, invest it elsewhere, pocket the difference. It was one of the most popular trades across the entire globe, and it led to Japan holding more US treasuries than anyone else in the world. Japan inflated their own currency, they sacrificed their own currency, and forced everybody basically to invest outside of Japan. Now, China are basically doing the same thing, but they're trying to keep the investment secured in China. In 2021, there was an enormous property crash by the Evergrande property conglomerate. You probably remember this. And what that's forced China to do is basically run the same playbook that got Japan out of the mess. What's that playbook? Print aggressively. Because if you print aggressively, the debt that you have to service is worth loads less. You've probably heard of the situation in Weimar Germany back in the 1930s, where they had runaway hyperinflation. Now, why does hyperinflation kill debt? Think about it this way. In Weimar Germany, you needed a wheelbarrow full of cash just to buy a loaf of bread. So imagine you had a debt tied to your house. Let's say it was 100,000 marks in debt that was tied to your house via a mortgage. Suddenly, a loaf of bread costs 100 million marks. Well, your debt on your house is not even worth a fraction of a penny at that point. So you can easily repay that debt. You've inflated away the debt, it's no problem. The people who get crushed, people with savings, in the currency that is being inflated. Holding hard assets basically solves this problem. And this is why we're seeing China go through this cycle, where gold is being used as the escape valve for their currency debasement. Now, it's important to remember that it's not just China buying gold. Gold is being bought by central banks all over the world. Poland were the largest buyers in gold last year in terms of central banks. But China have accumulated more gold since 2022 than any other central bank in the world. And what's important to remember with gold is that oftentimes the actual reporting of buying of gold by central banks is not exactly correct. Estimates generally say they underreport by 2 to kind of like 4x, and the real number is somewhere in the middle of that. But you can see there's clear accumulation of gold from central banks. I did a full show on this last week, which goes into a bit more detail. Go and check that out, as the rest of the world moves away from US treasuries and more towards gold. Definitely go and check that show out because it goes into more detail here. In this show, we're mainly just thinking about China buying gold and how that money isn't flowing into Bitcoin. So let's continue, because this is important to understand, right? Most of gold's market cap is locked away in jewelry. It's locked away in central bank vaults. It isn't openly traded on public markets. Bitcoin is the complete opposite. In fact, Bitcoin is so liquid, the only coins that are essentially off the market officially are lost coins. And even lost coins sometimes get found. But this efficiency in being able to trade Bitcoin actually hurts Bitcoin's price action somewhat, because so much gold is tied up and unable to be traded. From the start of 2024 to the high, gold had inflows, reported inflows, it might be higher than this, in terms of ETF inflows and central bank inflows, of about $269 billion. Yet, gold's market cap increased by $22 trillion. Absolutely wild. That means for every dollar that flowed into central banks and ETF buys, gold's market cap increased by 82 times that amount. Bitcoin, however, in that same period, $95 billion flowed in. Bitcoin's market cap increased by $1.6 trillion, which means that for every dollar that flowed into Bitcoin, its market cap increased by 17x. Now this gets even more interesting when you consider the prices today. From that 2024 inflow, gold's had about $269 billion in inflows. Market cap's increased about $21 trillion. So we're saying for every dollar that flows in, gold is moving by about 78 times that amount. Whereas Bitcoin is moving by about 4 times that amount. For every dollar that flows into Bitcoin, it's only increasing in market cap by about 4x. Terribly inefficient versus gold. It's kind of awful to look at, to be honest. And this is a common phenomenon actually, in that selling pressure in markets is asymmetric to buying pressure. All that means is that the same amount of dollars being sold of an asset tends to move the price down further than the same amount of dollars of an asset being bought. And just to sort of put the nail in the coffin, for every dollar that flows into gold or has flown into gold in the last 2 years, it's produced about a 20x move relative to every dollar that's flowed into Bitcoin. Now again, this isn't exact, right, because central banks tend to underreport readings of how much gold they're actually holding, but I applied some probabilistic analysis to this, and at the absolute worst case scenario, gold is about 4 times more capital efficient than Bitcoin, i.e. every dollar that flows into gold will increase its market cap about 4 times more than every dollar that flows into Bitcoin. And so not only do we have Bitcoin requiring loads more money to move it, we also have the portion of the economy that's expanding their money supply are cut off from Bitcoin, but they can access gold, right? Because buying Bitcoin, again, is banned in China. And so the world's largest money supply of $47 trillion in China, with an 8% year-over-year increasing amount and a central bank policy that is pushing more money into the economy, that portion of liquidity accesses gold and cannot access Bitcoin. Some Bitcoin might be being bought illegally in China, by all means. If you actually go through the numbers, this is only equating to about 1.5% of all Bitcoin volume. So it is almost negligible. Whereas the portion of the economy that's actively not expanding liquidity, yes, the US are going through $40 billion a month in reserve management repurchases. Since these have started, we haven't exactly seen these flow into the economy by any means. Again, these are funds that are attempting to patch issues in the financial system. Probably they will eventually flow into the economy in reality. But for right now, the US, the EU, the UK, they're all going through contractionary periods in their liquidity, or at least they're not expanding liquidity. And it is this portion of capital that can access Bitcoin. And so the key thing to understand is that gold has liquidity expansion from the globe, whereas Bitcoin only gets liquidity expansion from outside of China. And it is China who are expanding aggressively right now. And here's the other thing to understand. Bitcoin trades like tech. In fact, it trades like levered tech. And it exists inside traditional finance in the US. And as a result of that, it trades basically one-to-one with software, right? Which is kind of crazy. Bitcoin trades like software as a service, this particular ETF called the IGV. And it has done ever since about 2019. Just look at the correlation here. It's basically one-to-one. So because Bitcoin flows into these pools of capital, hedge funds buy BTC futures, they can trade the basis trade, which is a very commonly done thing. I'll explain what that is in a second. It sits inside the same trading book as traditional tech, which means that when these trades get unwound, Bitcoin gets unwound too. When these trades get hit, Bitcoin gets hit too. It doesn't matter that it's supposedly not software as a service. That is what it trades as, because the vast majority of people who trade it inside that same portion of capital that is allocated to technology. Needless to say, gold does not sit in this pool of capital that trades like tech. Gold sits as a completely separate portion in portfolios, in hedge funds, completely separate to Bitcoin. And it does that because it actively trades separately to those things. It genuinely isn't correlated, which is exactly what you want from different assets in a portfolio. Bitcoin is correlated, and it has been correlated for a very long time. So it cannot exist in a separate pool of capital. And evidence of this fact is back from February the 5th. We saw the largest day in IBIT, which is the biggest Bitcoin ETF, BlackRock's Bitcoin ETF. The largest day in volume happened on February 5th in that recent severe crash. Tech sold off, Bitcoin sold off. But again, this is just another nail in the coffin that Bitcoin is interwoven deep into US technology and the infrastructure that trades it. It's inside the same books. It trades exactly the same way. And that particular day was one of the worst days for hedge funds ever recorded, according to Goldman Sachs. So Bitcoin got absolutely hit as well. And this is just further evidence, right? Basically, the basis trade yield was sitting at like 3.5%, which isn't really very good. And then it spiked massively to 9%, which meant that these hedge funds had to sell their positions fast, which obviously forced Bitcoin price down even further. And so this is the key thing to understand. Capital flows, global capital flows, are the number one driver to asset prices across the globe. And right now, you've got China expanding its money supply. That money can only go into gold as that one safe haven store of asset, precious metals, etc. Of course, it doesn't all go into gold. Some goes into silver, some goes into equities. I know, not saying every single dollar goes into gold, don't get me wrong. I'm just saying that capital cannot access Bitcoin. You've also got the rest of the world that is not expanding anywhere near as much as China. Emerging markets arguably are, but the key economies, like the G7 of the world, most of those guys are actively shrinking their balance sheet. Japan are doing that. Europe are doing that. The US, as we've said, have been shrinking throughout the last couple of years. Now they're beginning to prevent that, but we are seeing right now that we're going to see a new Fed chair, and this particular Fed chair supposedly doesn't want to continue the crazy balance sheet expansion that we have seen from previous Fed chairs. Kevin Walsh has said multiple times, whether he does this or not, up for debate by all means, but he said multiple times he doesn't want to have those crazy balance sheet expansions that we saw during the Great Financial Crisis and COVID.
The Federal Reserve needs to get back to a lean, smaller balance sheet, and instead of being a general purpose agency of economic policy, a narrow and important.
And so the assumptions would be that actually the US are not going to be pushing a bunch of liquidity into markets via central banks, but they are planning on doing it via commercial banks. So it remains to be seen how this liquidity gets pushed into the markets. I think it probably does actually change things somewhat. But the key to understand is that over the last few months and right now, the pool of capital that's expanding arguably has no access to Bitcoin, doesn't want to go into it, and is basically banned from going into it. Now, don't get it twisted. I'm not saying this is the only reason Bitcoin has come down. As I've said, it's heavily tied to technology, trades one-to-one with technology. I even did a show about liquidity peaking about 2 months ago. Go check that out, saying that Bitcoin looks like it's turning around here. This probably was the top for now. And so Bitcoin's doing what it's always done and just goes down during these periods. It sniffs out liquidity first, moves down first, and tends to recover first as well. The point of this show isn't to say that the only reason Bitcoin's gone down is because China are unable to access it. It just adds another layer of information to your understanding of capital flows, which are the most important thing when it comes to global financial markets. And so, as I said, this isn't the only thing that has relevance. Of course it isn't. When it comes to understanding financial markets, every bit of information is another piece of a puzzle. The puzzle's very complex. It has so many unknown unknowns, so many variables going into it. If anyone says X equals Y, it must happen because of this, you can run a mile. They clearly haven't thought about the balance of probabilities of anything. However, this particular idea is very simple. There's a portion of capital from one of the largest economies in the world. The only form of debasement those people can hide in is gold. If Bitcoin becomes this extra store of value, it may not. No one's saying that it has to. Right now it trades like tech, we know that. Even if it is to become this, well, a very large portion of capital that it could become that for can't access it. It's a very interesting theory, I think. So that covers it. Let me know what you think of the theory. Do you think that China's expansion of global liquidity, not accessing Bitcoin, is something that even matters? And will eventually the EU, the US, etc., begin to unlock some more liquidity? Will it flow straight into Bitcoin, as it has done in the past? Because Bitcoin has been that barometer for sniffing out changes in liquidity in the past. If you enjoyed the show, please do me a massive favor. Give a like, leave a comment if you can. If you really want to help me out, you can share it with somebody as well. That goes a long, long way. I am very unknown on this channel, on a channel that has so many very, very famous hosts. So my shows always get absolutely killed by the YouTube algorithm. Maybe they're killed because they're terrible. Maybe they're killed because no one actually knows who I am. So if you could share it around, it really does make a big difference. I really appreciate it. Thank you so much for watching. I shall see you in the next one.